Topic 4 deals with the taxation of individuals. We will commence the discussion with individuals itself. When looking at SILC, you need to look at Chapter 7, which discusses natural persons, Chapter 17, which discusses capital gains tax, Chapter 26, which discusses donations tax, Chapter 27, which is estate duty, and then we will look at an ITR 12, which is a tax return for an individual. At the end of this chapter, you should be able to calculate the normal tax payable by a natural person, taking into consideration capital gains tax, estate duty, and donations tax. We need to start off with the taxable income framework. This can be found on page 143 in your SILC textbook. Your taxable income framework starts with gross income. You're going to add general and specific inclusions, including deemed inclusions. Then you subtract exempt income, which gives you income. You subtract deductions and then assess losses. Add any other amounts included in taxable income. Add taxable capital gains. Subtract any contributions to retirements. Then subtract donations, which gives you taxable income. You then have your section C is 6.2 quat and 6.2 rebates. Any additional tax which needs to be included, section 6A and 6B tax credits, which is medical aid. That gives you normal tax payable. Then you subtract your PAYE, normal tax due on assessment. If you have any withholding tax and withholding tax on dividends, they appear here. Then you have your total withholding tax payable, donations tax payable, total tax payable by a natural person. When you deal with individuals, you have two types of marriages. You can either be married in community of property or out of community of property. When you get married in community of property, all your passive income gets divided between your spouses. Out of community of property, what's mine, I get taxed on. What's my spouse's, my spouse will get taxed on. Now what usually used to happen is, a taxpayer is sitting in the high tax bracket of say 40+%. His spouse is sitting in the 18% category. He then takes money or tells his employer to rather give the money to his spouse, meaning his spouse will be taxed at a lower rate. So section 7.2 says each spouse is deemed to be taxed in his own hands. Thus, even though people want to cheat, they cannot cheat. The splitting of income from one spouse to other spouse in order to get a lower effective tax rate. All section 7s are anti-avoidance provisions. Thus, section 7 deems income that is split to be part of the spouse's income who worked for it. So back to my example. The husband works, he's in the 40+%. He says 3,000 rand of my salary must go to my spouse. Even though the spouse might receive that, we will deem that to be Mr. X's money and he will be taxed on that. We're moving on to minor children. Minor children are under the age of 18 after the 1st of July 2007. They are taxed in their own name on income which is received by or accrues to them, unless section 7 deems that the income to be received by the child's parents. So you've got your 3-year-old in your trolley and you're walking down the aisles of Pick n Pay when someone approaches you and asks if they can use your child for an advertisement. Now the child appears in Pick n Pay's advertisement. Any income that that child receives from the advertisement is deemed to be received by that child. However, you get instances where parents receive money and then they give that money through to their children and they want it to be seen as the child's receiving the money. So section 7.3 anti-avoidance says, if a parent gives a child money, the parent will be taxed on that money and not the child. Now we get people who think of these little fancy schemes. So Mr. X has his child and Mr. Y has his child. So Mr. X says, I will give your child, Mr. Y, part of my salary, and you give my child part of your salary. So there's a cross donation for your child and a friend's child. This is also seen as tax avoidance, and the parent will be taxed because the parent earns that income. Now I've made mention of page 143 of your textbook. The format is very important. You need to know the order of your deductions. Medical aid is no longer a deduction. It is seen as a rebate. So when we made mention of section 6A and 6B rebate, this is what it refers to. These deductions are important. You cannot calculate donations deduction and put it at a higher level than something else. It works with the taxable income of a subtotal. So therefore, if your subtotal includes a deduction, your deduction limitation will be incorrect. This is vital for exam purposes. Okay, we have donations. In order to encourage charitable contributions, donations are allowed as a deduction. The donation has to be to a public benefit organization that is approved by SARS in terms of section 30. A public benefit organization is any institution, board or body which carries on public benefit activities in South Africa or meets the additional requirements as prescribed by the minister. That's found in the second part of the 9th schedule. Public benefit activities is for the welfare and humanitarian issues, healthcare, education and development, conservation, environment, animal welfare, and land and housing. All schools and universities are thus public benefit organizations. So an individual will make a donation to a public benefit organization. They receive an official receipt, also known as a Section 18A receipt. To qualify for the donation deduction, an individual needs to be in possession of this receipt. You add all your donations made together for the year of assessment. That would be from the 1st of March till the 28th or 29th of February. The deductions are limited to 10% of taxable income before this deduction. Taxable income will exclude your retirement fund lump sum benefits received on or after 1st of October 2007. Now say for example we have donations to the value of 5,000, but 10% of taxable income is say 15,000. You need to limit your donation to what you actually donated, which is the 5,000. Medical aid rebates. Medical aid includes any contribution to a local or foreign medical aid scheme made in respect of the taxpayer in his or her spouse and dependents, and all amounts paid in respect of medical, dental and hospitalization expenses, payments to pharmacists for medicines obtained on prescription, and payments to nursing homes or a registered nurse, midwife for services supplied to the taxpayer, his or her spouse, and his or her dependents. Qualifying medical expenses do not include expenses that have been recovered from the medical aid scheme. Only the person who paid an expense may claim it. Payments by an employer which are treated as taxable benefits are however deemed to have been paid by the employee. The rebate consists of two parts, the first being the medical scheme fees tax credit, the second being the additional medical expenses tax credit. So when we look at rebate 1, we need to see how many people are on the medical aid, how long was dependence on the medical aid for, and we multiply a fixed amount which is given to us. So in respect of rebate 1, we look at 310 where the contributions were made in respect of the taxpayer only. If there was a taxpayer and a dependent, it's 620. If there's a taxpayer, dependent plus additional dependents, it's 620 plus an additional 209 per dependent. This is a monthly amount, so we need to multiply it by 12 for a year. Rebate 2, you either have individuals who are 65 and older, then we use a 33.3% of the qualifying medical expenses paid and borne by the individual, and an amount by the medical aid scheme contributions paid by the individual exceeds 3 times the scheme fee tax credit for the year. This also applies if there's any person on the medical aid who has a disability. The second option is if the person is under 65, you use 25% and you use an amount which exceeds 4 times the medical fees tax credit for the tax year, limited to amount which does not exceed 7.5% of taxable income. Now there's a lot of words in this. We need to look at a practical example so that you can see how it's dealt with. Okay, Gary is 44 years old. He's married and has no children. Now even though he's married, we still don't know if his spouse is part of his medical aid. His spouse can be on her own medical aid. His only source of income is his salary, which amounts to $136,000. During the year, he paid qualifying medical expenses of $11,000 and fees of $21,760 to the scheme. His wife is a dependent. Okay, so now we know he definitely has a dependent on the scheme. His employer contributed $9,240. Calculate taxable income of the normal tax payable by Gary. So we start off by saying Gary's age, 44. So he doesn't qualify for the 65 plus disability. How many dependents? They say he's married, no children, so 1 dependent. So what category is he in? If we look at the solution, we start off by saying his salary that he received, plus remember his employer contributed something to the medical aid, so that's a fringe benefit. His taxable income is therefore $145,000. Now we need to work out his tax per the tax tables. Where does this 145 fit? In the first category. So 145 times 18% is his tax payable. He gets a primary rebate because of his age, 14,067. So he's 44, that's all he qualifies for is his primary rebate. Section 6A and 6B is medical. Now 6A is the first part. We said it's him plus a dependent, so they get 620. Multiply that by 12, which gives you your first rebate. 6B we need to calculate. Now 6B, we know 21,760 was contributed by Gary, plus this 924, which is a fringe benefit, was contributed by his employer. So in total 31,000 was contributed towards the medical aid. We know 6A credits was this amount, 620 times 12, and 4 times of that. Remember the legislation says 4 times your 6A. So 4 times that gives you the 29,760. If you subtract the 2, you're left with 1,240. Then we said Gary had additional qualifying expenses of 11,000. So we add it, which gives us 12,240. Now the legislation says 7.5% of taxable income. So 7.5 of 145 gives us 10,893. If we subtract the 2, it gives us 1,347. Lastly, it says 25% of that amount. So 25% of 1,347 gives us 337. That is our 6B rebate. Now we know what he's supposed to pay in terms of his tax tables. We've got his primary rebate, we've got 6A rebate, 6B rebate. His normal tax payable is thus 4,299 rands. That brings us to the end of the discussion on taxation of individuals. Our next topic will be CGT.